Thomas, good to see you. A really interesting topic today. Why DIY investors earn less. According to Vanguard's Advisors Alpha study, a good financial advisor can add about 3% in net returns per year. Per year, that bears repeating. So, what
Absolutely.
do you think is behind that performance gap?
I think it's huge because we can provide you with professional advice, in regards to how the market swings and being able to manage your emotions. Because a lot of times, individual investors, they may sell, when the market is down, and having somebody that has experience in coaching through those periods can definitely end up saving you a lot of money. And I think
Mhm.
before even we've had conversations, Aaron, about maintaining the market, because even though it's down 20%, historically it's come back. So
Mhm.
in many situations, investors may change when they shouldn't.
Mhm. And it's
Mhm.
also about holistic planning, right?
Mhm.
Tax planning,
Absolutely.
rebalancing. So let's drill down then into a little bit more of the emotional investing, which you touched on, because according to Dow Bar, which is a very famous study, I know that you're very familiar with it,
Mhm.
DIY investors often underperform the market as well, because as you mentioned, they're driven by emotions. But explain exactly what's going on here.
Yeah. So obviously, when the market is high, you're in a state of euphoria because you're winning, right? But then when the market starts to fall, you may have some denial, anxiety, maybe potentially fear, and then you may sell. And then obviously, when the market goes up again, there may be some more optimism. So we look at a more of a passive strategy than technically, or having that active management where you're selling when the market is potentially going down. So.
Mhm. Yeah, having a plan
Yeah, for
makes
sure.
you not react emotionally. So
Mhm.
many DIY investors believe they can save money by avoiding advisory fees. How
Yeah.
do you help clients understand the value you provide?
Yeah, because first of all, we're going to come out with a holistic plan. And when you're thinking about an advisor that's been in the industry for roughly 15, 20 years, that's a lot of experience. And when you're thinking about doing it yourself, you may not have the understanding on how to navigate through certain market downswings. So just having that advisor to be able to generate a plan and be able to give you sound advice can definitely save you a lot of money in the future.
So, for someone then who's thinking about hiring an advisor, what's the best way to start that conversation to determine if they should? And what should they expect in that first conversation?
Obviously, there has to be some synergy in regards to goals.
Yeah.
I think that understanding what you're trying to accomplish is really important. And if the advisor can help you with that, and then I would say what's huge is transparency and communication. Being able to have an advisor that you can talk to and that will call you, and be able to be very, very real with you in regards to what your expectations are.
Hmm. Well said. All right. Well, Thomas, if somebody would like to talk through whether or not they should hire a financial advisor, what's the best way to get a hold of you?
Yeah, definitely go to my website. It's at martinheritagegroupllc.com. You can give me a call or shoot me a text at 651-503-6064. You can also shoot me an email at info@martinheritagegroupllc.com. And then lastly, I'm on all social media platforms at Martin Heritage Group.
Great. Thomas, thank you.
Thank you.